In the previous videos, we covered the basic concept of pair trading, reviewed the main indicators and metrics I use, and walked through the TradingView layout that supports the strategy. In this video, we'll focus on one of the most important metrics in pairs trading: correlation. We'll also take a deeper look at the entry and exit points and how these elements come together to create a reliable trading setup. Let's talk about correlation, one of the most important factors in pairs trading. Without strong correlation between the two stocks, this strategy simply won't work as intended. The good news is that you don't need to calculate correlation manually. There are plenty of tools that can do it for you. In TradingView, you'll find many correlation indicators, including one that I developed specifically for pair trading. It's completely free to use. Just search for symbols correlation built for pair trading. A direct link is also available below this video. On the right side of the slide, you can see additional details that explain how correlation influences the quality and reliability of the trade. Before we look at the two types of correlation, let's start with the basic idea of what correlation actually is. Correlation measures the relationship between two assets, essentially how the price of one stock tends to move in relation to the other, and is measured with range between 1 and -1. If your pair is close to 0, you have no correlation. If your pair is close to 1 or -1, your pair correlation is high. A high and stable correlation means the two stocks usually react to market conditions in a similar way, which is exactly what we're looking for in a pairs trading strategy. Now, correlation can behave in two different ways, and you can see that very clearly here. We have two examples, one with positive correlation and one with negative correlation. In each example, you can see three candlestick charts. The large chart at the top shows the pair ratio. The middle chart shows the symbol with the higher price, and the bottom chart shows the symbol with the lower price. In a positive correlation, both symbols tend to move in the same direction. When one goes up, the other usually goes up as well, and the same applies when they move down. And you can see how both high and low symbols in the left example move together. In a negative correlation, the movement is opposite. When one symbol rises, the other typically falls, and this can be viewed in the right example. Both types of correlation can be useful for this strategy, depending on how the ratio between the two stocks behaves. What matters most is that the relationship is consistent over time, because that consistency is what allows us to predict and trade the deviations with confidence. Let's take a look at two more examples to better understand correlation and to see how the TradingView indicator I created specifically for pairs trading works in practice. Personally, I prefer positive correlation, and both examples on this slide show pairs with strong positive correlation. I do trade negative correlation as well, but my statistics are better with positive pairs. Of course, other traders may prefer negative correlation, and that's perfectly fine. It depends on the strategy and the trader. As you can see on the right side, my indicator includes a large gray area between 0.85 and -0.85. When the correlation is inside this range, I generally avoid trading the pair. In my opinion, the connection between the symbols is too weak. The first thing to notice is the difference between the two examples. In the upper pair, correlation is stable and consistently high, while in the lower example, it fluctuates, showing clear signs of instability. And if you compare the price movement of the two symbols, you can see that in the upper pair they move in a very similar way, while in the lower example the symbols eventually reach similar positions, but the movement itself is not aligned. Now, let's quickly review how correlation is used within this strategy. We're looking for a moment when a highly correlated pair suddenly creates a gap, meaning something happened that caused the two symbols to move in a way that is not consistent with their usual behavior. This gap is measured using standard deviation, or as most traders know it, the Bollinger Bands. In the examples on the slide, you can see my indicator marking these moments with a red arrow from above or a green arrow from below, depending on the direction of the deviation. We never rely only on correlation and Bollinger Bands. We also examine momentum, ADX and DI, historical trade behavior, recent news, and several other metrics. But when all the conditions align, we enter the trade with the expectation that this statistical gap will close and that the price relationship will return to normal, which is where the profit comes from. The exit with profit happens when the statistical deviation closes or comes very close to closing. In practice, this means the pair ratio returns toward the middle Bollinger Band. You can see the purple arrows in the examples on this slide marking the optimal exit points. Personally, in most cases, I don't wait for the gap to close completely. I usually exit once the ratio is near the middle band. If you prefer taking on a bit more risk, you can choose your own exit level. That part is up to your risk tolerance and trading style. There are also techniques where you close only the losing position, either the long or the short, and keep the winning side open. But this approach is riskier, and it forces you to stay in front of the screen during the trading hours. I personally prefer keeping things simple and spending less time actively monitoring the charts. Metrics and indicators are important, but they're not everything. In trading, even when all the signals look perfect and every indicator gives you a green light, the trade can still move in the opposite direction, and you can lose money. When you evaluate a trading opportunity, be careful and try to avoid these common mistakes. Entering trades against the trend, taking entry signals right after a gap in the pair ratio, or entering a trade simply because it looks good visually, even though no valid signal is present. We'll talk about risk management and how to stay consistently profitable in a dedicated video later on. But for now, remember this: to stay profitable, you must focus on avoiding losses just as much as making gains. Stick to your rules, follow your system, and stay disciplined.